In today's video, you'll see part 3 of my interview with certified financial planner professional Brent Bowden, in which we discuss the single greatest roadblock to a tax-free retirement.
Look a little bit beyond just kind of the technical aspects of the tax-free retirement and look where you learn. What kind of mind shift things do you have to do or habits do you have to change to really start thinking about what's your long-term financial wellness and those tax implications? What are you thinking mentally? So we talk a lot about kind of behavioral finance and things that you have to think about. Obviously, life insurance is a long-term investment. That's something you're going to do and try to take out money in 6 months. So what does that take and kind of habits do you have to form around committing to more of a tax-free retirement?
Well, one of the big things that from a psychological standpoint, is you have to be prepared to pay a tax before the IRS absolutely requires it of you. And this can be a huge roadblock for a lot of different people, because we're basically saying, let's prepay a tax. Let's pay a tax, because what do most people do? They wait until they're forced to take money out by way of those RMDs, and that's when they pay the tax. And what we're saying is, look, we're sitting on the train tracks. We can see that tax freight train off in the distance. It's bearing down on us. We know roughly when it's going to get here. We know roughly what the consequences are going to be when it does arrive. Let's sort of, in a very premeditated way, systematically reposition our assets off the train tracks into these safe havens that are called tax-free retirement accounts. And let's do it in a very premeditated sort of a way. The problem is, even if we can make the case that tax rates down the road could be twice as high as they are today, people have a hard time pulling the trigger. And so you just have to be, in terms of psychologically how you can embrace this sort of a paradigm, you have to be willing to pay a tax prior to when the IRS absolutely requires it of you. And that can be beyond the pale for some people. The other thing is you have to be willing to jettison a lot of these false narratives that maybe you've heard over the years from the likes of Susie Orman, Dave Ramsey, Clark Howard, White Coat Investor, Ramit Sethi from Netflix. These guys that say that they paint everything with a broad brush. They have a very unnuanced approach to tax-free retirement planning. Dave Ramsey, for example, says don't. Anybody who does cash value life insurance either hasn't investigated it enough, or if they have and they still do it, they're just a dupe. So you have these financial gurus. I'm actually writing a book on this right now, Financial Gurus, how they paint everything with a really broad brush. And so they have no nuance, and they're one size fits all financial planning recommendations. And so sometimes we have those old, outdated paradigms that are cluttering up our thinking. And what I say is the best way to cut through all of the unnuanced, one size fits all recommendations is to look at the math. Take a look at the math. Compare, for example, the IUL versus a typical bond portfolio, or compare it to your brokerage account. Which one is likely, mathematically speaking, to push you further ahead? And the best way to cut through all that nonsense is just to look at the math, which is why I think it's so important to do a before and after comparison. This is how long your money would last under the tax deferred paradigm, and this is how long your money would last under the tax-free paradigm. And whichever one pushes you further ahead, that's the one you adopt.
So I know you've been doing this long enough. You've probably got some clients that have moved over from accumulation phase to distribution phase and are successfully in that tax-free zone. Just from a visualization, because it's hard for a lot of people to understand that they retire and don't have to really pay taxes again. What does that look like for a client for you?
Yeah, so you're gonna I say this in all of I do about between 50 and 100 presentations to groups across the country per year. And what I always tell them at the end of my presentations, I say, look, I've been doing this for 25 years. And one of the things I've concluded is that it is impossible to get to the 0% tax bracket by utilizing just one stream of tax-free income. To get to the 0% tax bracket typically requires between 4 and 6 different streams of tax-free income, none of which show up on the IRS's radar, but all of which contribute to you being in the 0% tax bracket. So let's list what some of these tax-free streams of income are. We love the Roth IRA. We love the Roth 401k. We love the Roth conversion. We love taking money out of your IRA up to your standard deduction without paying any tax at all. A lot of people don't realize they make the mistake of converting all their money to the tax-free bucket. And then when it comes to retirement, they don't have any taxable income left. And so that standard deduction sits idle. You should, as a married couple, you should probably leave between $350,000 and $400,000 in that bucket. You've got the LIRP, and if you can keep your provisional income low enough, then you have your Social Security tax-free. So what we're describing here is a strategy that calls for between 4 and 6 different streams of tax-free income. And so the idea here is to take advantage of every nook and cranny in the IRS tax code, every tax-free nook and cranny in the IRS tax code. And if you find yourself in a position right now where you have all of your money in the tax, to tell a quick story, not long ago at the end of my presentation, a lady comes up to me and she says, Dave, I got all my money sitting in the tax deferred bucket. I'm in a really bad mood. I said, why are you in a bad mood? And she says, because, there's nothing I can do. It's all sitting in the tax-free bucket. I said, let me make sure I understand this correctly. You contributed to your tax deferred bucket at a period in time when tax rates were much higher than they are today. You got a deduction of those higher rates for doing so. You now have a 3-year period of time during which to take advantage of historically low tax rates. If you go out to 2030, it's even longer. During which to take advantage of historically low tax rates so you can get those tax deferred assets systematically repositioned to tax free so that by the time tax rates go up for good, you've done all the heavy lifting and you can take that money out tax free. I said, is that why you're in such a bad mood? She says, well, gosh, Dave, I never really thought about it that way. So most people, frankly, 95% of Americans have the lion's share of their money in that tax deferred bucket. And so if you're at the stage in your life where you're starting to think about stuff like this and you can see the tax rate train looming off in the distance, how hard it's going to hurt when it comes, roughly when it's going to arrive, then you need to just start thinking about systematically repositioning that money. And this is what I tell people. I say, you want to shift that money slowly enough that you don't rise into a tax bracket that gives you heartburn, but you want to do it quickly enough that you get all the heavy lifting done before tax rates go up for good. And that's so the idea is to optimize, to stretch the tax obligation out over as long as it makes sense, so that you pay as little tax along the way, but you get all the heavy lifting done before tax rates potentially double or just rise dramatically. And so that's really what we're talking about here. And obviously everybody's different, but we're talking Roth conversions. We're talking maybe repositioning a portion of that conversion, peeling it off and sticking it into an IUL so that you can get a death benefit that doubles as long-term care. You're getting safe and productive growth that maybe takes the place of your bond portfolio. So those are the types of things that we think about when people are at this stage in their game when they want to protect themselves.
So it kind of leads me to the next question. If there's one part or one piece of advice to take away from your books and your talks, what would that be to medical professionals specifically? Why?
Well, I guess I'm going to just lump the medical professionals into everybody else I talk to. And that's just to start paying more attention to the fiscal condition of our country. When we, I did a movie called The Powers Year, The Tax Train is Coming, where we crisscrossed the country and we interviewed all the most important experts in the nation on the national debt as it relates to the future of tax rates. And they're all saying, look, when we borrow money, we are agreeing to a tax in the future. Okay? The more money we borrow today, the more we are implicitly agreeing to paying a tax in the future. Okay? So we just need to affect this paradigm shift wherein we recognize that the more we accumulate debt as a country, the more likely my personal tax rate is to be dramatically higher even 10 years from now. And so, and every year that goes by where we fail to take advantage of historically low tax rates is potentially a year beyond 2030 when we could be forced to pay the highest tax rates we're likely to see in our lifetime. Folks, this is, people say, well, we'll just print our way out of the problem. Well, most of the debt that's going to be accumulating over the next 30 years is because of unfunded obligations for Social Security, Medicare, and Medicaid. All three of those things are tied to inflation by law. We're required to index them for inflation by law. And when we say we're going to print our way out of the problem, what happens when we print money? That increases inflation. So it increases, if we print money to pay for the unfunded obligations, we're also going to be increasing the expense of these programs commensurately. So it's like a dog chasing its tail. It never really catches up. And so there's only so many options left. You can cut Social Security, Medicare, and Medicaid, or you can raise revenue. I think ultimately what's going to happen is going to be some combination of the two. But either way, you're not going to escape the reality that tax rates are going to go up. And if that's the case, then we really should not let a year go by where we're not taking advantage of these historically low tax rates. Now, does that necessarily mean that all of your healthcare professional clients should be doing Roth conversions? Not necessarily, because they're already in a really high marginal tax bracket and they may be in a lower tax bracket later on, but it does mean they need to focus a little bit more on how they're growing and compounding the money in their taxable bucket. There may be better alternatives to what they're doing.
I think it's a good point. We talk a lot about just planning, knowing exactly when you need to make changes, when can changes occur. It doesn't necessarily mean you have to take advantage of all those today. It might not be the best time. But I think if you have a consistent, comprehensive plan, it'll get you there at some point. So love that.
That's right.
Well, David, I certainly have appreciated talking with you, getting some great advice. Is there anything else that we should know about your movie, your books, your talks that we need to check out?
I always joke that if you want to check out my YouTube channel and you really want to learn these principles, I tell people, if you watch my YouTube channel for 6 months, you'll turn into David McKnight, only without the 7 kids. But if you want the 7 kids, I can show you how to do that too. So really, if you want to learn about this, and it sounds like you've done a great job of embracing this in your own practice, but read my books, YouTube channel, and you can stream that movie pretty much wherever you stream movies, The Power of Zero. We did that back in 2018, so the numbers have changed ever so slightly in the interim, particularly because of COVID. We had to borrow $6 trillion during COVID, so the debt ramped up. Everything you see in the movie is much worse than it's much worse today than what you see in the movie. But yeah, those are some good resources if people really want to sort of wrap their brain around this stuff. Okay, folks, that was part 3 of my interview with certified financial planner professional Brent Bowden. If you would like some help implementing a balanced, comprehensive approach to tax-free retirement that shields you from the impact of higher taxes down the road, head on over to davidmcknight.com and click on the Connect with an Advisor button. I'm happy to refer you to an advisor in the Power Zero network that has been trained, vetted, and qualified personally by me. If you're a financial professional and want to learn how to become a certified Power Zero advisor, head over to powerzero.com and opt into my free video series. If you have any comments or questions, feel free to drop them into the comment section below. I'll respond to every single one of them personally. And don't forget to click like, subscribe, and the bell so you never miss a video. This is David McKnight. I look forward to seeing you on the next video.